There's a reason some families quietly build wealth that lasts generations, while others hit seven figures and then lose it all within a decade. And it's not access, it's not luck, it's not even intelligence. It's how they think, how they allocate, how they make decisions when the market gets noisy. Family offices don't play the same game as most investors. And that's exactly why they win. While retail investors are chasing alpha or some trendy new investment scheme, family offices are engineering resilience. While most people focus on return, they focus on stability, optionality, and control. They think in terms of systems, not just assets, relationships, not just returns, and risk architecture, not just upside. Most retail investors, they're overwhelmed with content, flooded with deal flow, chasing five different strategies at once, because everyone told them you need to be diversified. But the wealthiest families I know don't confuse motion with intelligence. They're not trying to be everywhere. They're trying to be right in the few places that matter the most. And what's wild is this. These aren't secrets. Family offices aren't doing something magical. They've just had time to refine a way of thinking that most investors never get exposed to. So today, I want to open the door. I'm going to show you what family offices actually know, the principles they follow that most retail investors never hear about. And no, this isn't theory. This is what I live. Because after exiting my business, I built my own family office. Not a fund, not a brand, a true capital allocation platform designed to protect, grow, and steward wealth, not chase headlines. And that process changed everything about how I see investing. It taught me how to think slower, say no faster, and build structures that perform even when the market turns. In this episode, we'll go deep on why family offices don't chase returns, they design for durability, why they underwrite people first and numbers second, and why the portfolios they build aren't just diversified, they're architected. I'll also share a personal story, a moment when I almost followed the crowd, until I remembered what game I was playing. And by the end of this episode, you'll have a new lens, not just to evaluate deals, but to evaluate yourself as an allocator. Because if you want to build wealth that outlasts you, you can't keep trying to think like a retail investor. So let's get started. If there's one principle that separates how family offices invest from what most people invest, it's this. They don't chase return. They engineer resilience. And that sounds simple, but it's everything. Most investors are trained to think in terms of performance. What is the IRR? What is the cash on cash? How soon do I get paid? They're always looking up. They're chasing upside, optimizing for maximum yield. But family offices, they start looking down at the floor, at the worst case scenario. Not because they're pessimistic, but because they're disciplined. They don't ask, how much could I make if this works? They ask, how bad does it have to get if this doesn't? Because if they've learned something most people don't realize until it's too late, the most important number in investing is not your return. It's your max drawdown. How much you can lose and how fast you can recover. That's the game. Family offices structure their entire portfolios around one core truth. Preservation precedes prosperity. If you lose 50% of your capital, you need 100% gain just to get back to zero. But if you lose 5%, you only need 5.26% to get back to zero. You think that math is boring? Family offices think the math is everything. That's why they build portfolios that bend but then don't break. They use preferred equity, structured debt, capital stack positioning, and disciplined sponsor relationship. They're not in love with yield. They're in love with durability. Let me give you an example. Last year, we reviewed two nearly identical multifamily deals. Same state, similar vintage, identical IRR projected, which was 16%. One was structured as common equity, the other one was preferred equity with a fixed 9% return, capped upside, and seniority in the waterfall. Most retail investors would have picked the 16% equity deal because it looked like more. We went with preferred. Why? Because it had 4 layers of downside protection: sponsor co-investment, interest reserve, rate cap, a hard exit trigger. The retail investor is asking, how much can I make? The family office mindset is asking, how do I structure this so I can't lose? That's resilience. And when the market softens, and it will, that's the thinking that survives. Now let me take this even further. Most people confuse volatility with risk. They think that if something feels risky, it is, or if it feels stable, it's safe. But real risk is what you don't see coming. It's what happens when your assumptions break. It's when refinance doesn't clear, when cap rates expand, when liquidity disappears. Family offices are obsessed of building around that. That's why they keep dry powder. That's why they stress test deals under multiple scenarios. Why they're willing to take 9% return, they understand over 15% return built on hope. Because they've already seen what happens when things go sideways. And they've made peace with the fact that wealth is building on staying on power. That's the part no one talks about. Everyone's trying to win big, but the best investors, they're trying to not lose big. They want to stay in the game year after year, cycle after cycle, because if you can keep playing, you don't have to be brilliant. You just have to be consistent. So here's my challenge to you. The next time you're evaluating a deal, don't start with the IRR. Start with a risk stack. Ask, where do I sit in the capital stack? What assumptions are being made about exits, rent growth, and debt markets? What happens if this takes 12 months longer than expected? What if it underperforms by 20%? And then ask yourself, would I still be okay? If the answer is yes, I think you might have something. If the answer is no, it's not resilience, it's roulette. You want to think like a family office. Build your portfolio around what happens if it doesn't go well. And when it does go well, then that's just upside bonus for being disciplined. Let's keep going. And in the next part, I'm going to look at something that's very counterintuitive that family offices do better than almost anyone else. They underwrite people first and projections second. Because a spreadsheet can say anything, but the person behind the deal, that's what actually drives the outcome. Let's talk about it. There's a line, and I've heard it over and over again from investors who've been around for decades. They say, I don't invest in deals, I invest in people. Now, that sounds something that you put on a coffee mug or perhaps on a slogan. But family offices, it's a discipline and a very serious one. Because they've learned the hard way. The spreadsheet never makes the decisions. The sponsor does. And that means it doesn't matter how good the IRR looked on paper. If the operator lacked integrity, focus, or maturity, that IRR is just decoration. Family offices are obsessed with sponsor quality because they know that real estate is not passive. It's not autopilot. It's not just buy and wait. It's execution, day in, day out. And who you partner with is the difference between a boring win and a catastrophic loss. And most retail investors, they fall in love with the numbers. They get impressed by pitch decks. They assume competence because the deal looks sharp. But family offices, they do background checks. They'll call past partners. They ask uncomfortable questions. And most importantly, they watch how sponsors respond when challenged. Let me give you a real example. We once passed on a deal where the deal itself was fine. It was a sponsor that raised a red flag. They had a great track record on paper, plenty of social proof, very nice office, strong brand, but then the diligence call, every answer was polished and vague. I asked, what's the time your projections were wrong and how did you respond? They said, oh, we've been pretty accurate so far. And when I pressed and I asked them what was their worst performing asset, what did they do differently? What lessons have they learned? They dodged. And in that moment, I knew this person wasn't humble enough to hold capital through a storm. They were still trying to look smart, not be transparent. And that is a hard pass. Because when things go wrong, and they will, you don't need a storyteller. You need a strategist, someone who can make the hard decisions, own mistakes, and communicate early and clearly. and protect investor capital like it's their own. Family offices don't just underwrite track records, they underwrite character, they underwrite communication style, they underwrite emotional maturity. They'll often pass on higher return if it means investing with someone that's already proven that they can navigate a downturn. Because here's the thing no one tells you: your sponsor is the first line of defense and your greatest point of failure. And if you don't know how to vet them properly, you're not investing, you're just like outsourcing. Now, what does it mean to underwrite a sponsor well? It means asking real questions like, how do you personally make money in the deal and when? What's the last time you had to pause distributions and how did you handle it? What do you do when investors push back? What are you not good at? Who covers that on your team? It also means watching what they don't say, how they handle friction, whether they follow through after the first call, whether their team is prepared or they're just polished. Because here's what family offices understand intuitively: most deals don't fail because of the asset, they fail because of ego, sloppiness, or silence. So when you're allocating capital, especially into private markets, you need to make peace with one truth: you're not buying the deal, you're marrying the operator. And if you can't trust them to manage your and if you wouldn't trust them to manage your capital during a market correction, you shouldn't be handling them your money during a bull market. At Infinity 9, this is a non-negotiable. We've passed on plenty of great deals because the sponsor didn't pass the people test. Because long-term wealth isn't about finding great properties. It's about building great partnerships with people you trust, who tell the truth, who communicate in real time, and who take the hard road when it protects investor capital. Let me close this idea with something personal. I've had deals that underperformed, but never did I lose sleep because the sponsor called me first. They explained the issue, they laid out the plan, and then they executed. I've also had deals that looked fine on paper, but the sponsor went dark the moment things got hard. It was the same IRR on the pitch deck, completely different outcome on real life. So here's the takeaway. If you want to start to think like a family office, stop looking at the pro forma and start looking at the person behind it. Because spreadsheets can't make decisions, but people will. And when you get the people part right, you don't just protect your money, you protect your peace. Let's keep going. And in the next part, I'll show you how family offices don't build portfolios like collectors. They build them more like architects. Clear structure, defined roles, and everything with a purpose. And that mindset, it really changes everything. Most retail investors build portfolios like collectors. A little of this, a little of that, some multifamily, a bit of crypto, a few stocks, maybe a GP's friend's deal, maybe a self-storage fund from a webinar. They're constantly picking up pieces, adding exposure, diversifying, collecting assets like they're filling a shelf. And on the surface, it looks pretty productive. It looks like momentum, but under the hood, it's a lot of chaos because most of it isn't built with a plan. It's built around opportunity, around what came in the inbox last, or who pitched hardest, or what looks safe on YouTube this month. Family offices don't build like that. They don't collect assets, they architect portfolios. Every position has a reason, every asset has a defined role, every investment serves in the larger structure. Think of it like this. If you ask a retail investor, what role does this deal play in the broader capital strategy? Most of the time, they'll get a blank stare. If you ask the family office the same thing, they'll tell you exactly. This is our stable cash flow sleeve. This is our long duration growth with no liquidity need for 7 years. This sits junior in the stack and we've capped exposure to 5% of our NAV. They know why every position exists. And more importantly, they know what would cause them to exit it, shift it, or double down. It's architecture: clear, intentional, and load bearing. And here's the mindset shift I want you to make. Your capital deserves more than diversification. It deserves a blueprint. Let me break this down. Family offices typically build across 3 strategic zones. Stability. These are income generating, low volatility positions. Think preferred equity, senior debt, or maybe even triple net retail. The goal here isn't to get rich, it's to stay liquid, stay safe, and cover baseline needs. Second is growth. This is where you take calculated bets. Development deals, common equity in strong markets, private equity, or maybe even operating businesses. You underwrite for upside, but with clear limits and guardrails. And the third one is optionality. This is dry powder, opportunistic capital, to the ability to say yes when others can't. Family offices don't want to be fully deployed. They want to be strategically available. And that third bucket, that's what most retail investors completely miss. They think the goal is to always be fully invested. But family office know dry powder is not dead capital. It's in your seat at the table when the market dislocates. And I find that to be architecture. Now, what happens when you start thinking like that? Instead of thinking, is this deal good? You might start asking, does this deal fit? And that is a big difference because good deals come along all the time. But a deal that fits your structure, that protects your downside, enhances your yield, or fills a strategic gap, find that to be rare. So, what does this look like in practice? Let me give you an example. A client came to us after selling a business with roughly $10 million to deploy. Before we touched a single investment, we went 2 weeks mapping out their liquidity needs, their tax strategy, their psychological risk tolerance, and their legacy goals they had for their family. Then we designed a capital stack, not just a list of deals, a stacked strategy. 35% into structured income with defined distributions, 20% into long hold value add real estate, 15% of private credit, 10% of venture, capped and containerized, and 20% held back for opportunistic pivots. We knew the role of each dollar, how long it would be deployed, when it would come back, and what to do if the market moved. That's not a collection, that's construction. And the impact? 2 years later, he was not chasing deals, he was evaluating fit. He's not stressed out about volatility, he's structured for it. And he's not relying on hope, he's operating from design. That's the level I want you to go to. Because once you shift from collector to architect, everything changes. You stop asking, what's the return? And start asking, what does this piece do for my bigger picture? You stop being reactive, you start being strategic. You stop trying to impress with what you own. You start building peace through what you understand. Family offices don't just build fast, they build right. And you don't need $100 million to think like that. You need a plan, a framework, and a discipline to follow it when everyone else is changing, and the discipline to follow it when everyone else is chasing the next shiny thing. So here's the takeaway. Start treating your portfolio like a blueprint, not a basket. And you'll start making decisions that last longer than any bull run ever will. In the last part, I'll share a personal moment when I finally started thinking like a family office. And what changed that moment, I stopped collecting deals and started building something durable. And it didn't happen all at once. It wasn't like a 1 day thing. There wasn't one dramatic moment when I suddenly thought, oh, now I think like a family office. It came slowly, through frustration, through stress, through moments where I looked at my portfolio and thought, what exactly am I doing with all this? I remember one deal in particular. It was a multifamily syndication with huge returns in a very interesting market. The sponsor I liked, so I said yes. At the time, it felt kind of strategic, but when I look back a year later, I realized that I had no idea why I did it. Beyond the surface numbers, it wasn't part of my system. It didn't solve any capital need. It wasn't balanced by anything else I owned. It wasn't like, when you allocate capital, you need to think like chess. Every move needs to have something that balances or protects it. But in this case, it was just another deal. And then it looked like everything else that was in it. Some preferred equity here, a startup over there, a couple of development deals in completely unrelated markets. And then it hit me. I didn't have a portfolio. I had a pile of decisions, a pile of strategies, and a pile of assumptions with no architecture to hold them together. And that's when I stopped. I cleared my calendar. I paused new deal flow, and I asked myself the question I now ask every investor I work with. What game am I actually playing? Is it about income? Is it about legacy? Is it about freedom? Is it about conviction, security? Because if I don't know the purpose behind the allocation, then all I'm doing is reacting. That was a turning point. It was when I started building my own family office, not as a status symbol, but as a way to finally think clearly, to see capital not as a trophy, but as a tool, to stop chasing opportunity and start executing a plan. Since then, I've said no to deals that I would have chased 5 years ago. I've walked away from complexity, and I've even cut relationships that look great on paper but didn't meet the new standard. And more importantly, I've built peace. Not just cash flow, not just performance, peace. Because once your capital is aligned with your purpose, you stop trying to prove anything. You just build quietly, deliberately, sort of like an architect. So here's what I want you to take away from this episode. You don't need $100 million to think like a family office. You don't need a staff or a family crest or a vintage leather bound balance sheet. You just need to shift. A shift from reacting to designing, from collecting deals to building a structure, from chasing returns to engineering durability. Because that's what a family offices know and what most investors never learn. The game isn't about how much you can make, it's about how well you can think. Over time, across cycles, through uncertainty, and I find that that's the edge. Family offices protect the downside first. They underwrite people before projections. They don't just diversify, they try to assign roles to every asset. They move slow, they say no more than yes, and they always build for longevity over popularity. But most importantly, they invest like stewards, not speculators. And that's what I want for you. Not just more assets, but more alignment. Not just capital that grows, but capital that compounds with intention toward a future you actually want. So here's my invitation. Take a day, step back, look at everything you're in and ask, why did I say yes to this? What role does it play? What happens if it doesn't perform? Would I allocate this way if I had to start over again today? Those questions are beginning of clarity. And once you have clarity, you stop collecting and you'll start building. And you can start thinking like families who stay wealthy quietly for generations. If this episode gave you that pause, that wait, I've been thinking about this wrong moment, great. That means it's working. And if you want more, that's what we're doing here every week. Teaching real estate discipline, one decision, one mindset shift, one better framework at a time, with no hype, with no pitch, just stewardship. Because that's the game, and now you're playing it.